why I would say that fixed income investment is something that people should be focusing on. In I know that I'm talking about fixed income, or I was supposed to talk about fixed income, but at the same time, I would also like to get people's attention to a lot of other alternative investment classes. So equities, stock markets are really popular in news media. We also, maybe me as an academic included with everyone else, maybe we just focus a lot more on valuation of stocks, valuation of companies, and teaching that in classes, and focus a lot more on equities in general. There are so many other different asset classes. There are real estate markets, for example. There are corporate bonds, there are government bonds, so on and so forth, right? These markets have a lot less competition, but these are also really big markets with really big opportunities in general. So point being that alternative investment classes have been ignored traditionally when you talk, especially to finance folks, and that shouldn't be the case. Crypto, for example, is getting a lot of more attention these days. Again, I would just view that as an alternative investment opportunity set of something that you're going to be able to invest in. So that's why you should be focusing on alternative investment assets. I can talk about a couple of projects or cases that I worked on, especially in fixed income or alternative investment class type of products. So before I get there, when I said cases, so I used to work in litigation consulting at Cornerstone Research in New York. What we did there was essentially, suppose that there's a big financial scandal. Take your pick out of Wall Street Journal's frontline stories about some financial scandal. For example, LIBOR scandal. We worked on cases on those litigations. We worked on actually working in terms of, suppose that the company is allegedly doing some fraudulent activity. They haven't disclosed something. Suppose that the CEOs are trading insider, they are using insider information to trade, or Elon Musk tweets, for example. Things like that is what we worked on. We essentially tried to see, one, was there any fraud? Two, if there was fraud, how much damage was done? And that was our main goal there. And we worked on both sides, plaintiffs or defendants. What would happen? So what happens in a typical litigation is you have your plaintiffs, you have your defendants. Each of these sides will have their own lawyers. These lawyers are great at making really, really lengthy arguments and writing really annoyingly long reports, but they are not great at finance or aspects of assessing damages as much. And that's why they would hire us. That's why they would hire us and ask us, hey, was there any fraud? If there was a fraud, how much do you think the financial damage was done, right? So the first case that I worked on, and I can't provide exact case details, so this information is going to be vague, but the first case I worked on was on bonds issued by government agencies. So when you're talking about bonds issued, or just in bonds in general, there are a ton of different types of bonds that you can trade on out there. There is your corporate bonds, as in, Apple Inc. will issue some bonds. Every single company out there, corporate company, whether they are publicly listed or not publicly listed, they can issue bonds. So those are your corporate bonds. In addition to that, you have government bonds, and these are much bigger market than corporate bonds. So US Treasuries issue T-bills. Those are government issued bonds, treasury bonds. There are government agencies like Fannie Mae, Freddie Mae, Ginnie Mae. These government agencies issue bonds as well to raise money. For example, Fannie Mae issues bonds to the general public to raise money and then use this money to be able to finance people's home mortgages as they purchase people's mortgages, right? So obviously, the third type of bond that's being traded out there is mortgages or general housing mortgages type of things. So in addition to that, more on government bonds side, you have your municipal bonds. Your municipalities sometimes issue bonds. These days, not a lot, some universities have started issuing bonds to raise money as well. So there is a ton of different types of bonds out there. I was specifically working on a case where there was an alleged price manipulation happening in issuance of agency bonds. And when I say agency bonds, these are bonds issued by some government agencies. And honestly, before that case, my knowledge about fixed income was very minimal. My dissertation when I wrote it was in how to predict aggregate US stock market returns, literally like how do you predict S&P 500 returns, for example. Things like that. And my knowledge was very, very minimal. But that case actually caught me in this jumble of fixed income or alternative investments, because not a ton of people even in that firm understood. And Cornerstone Research is one of the top litigation consultancies that are out there. But not a ton of people even in that firm had the complete grasp of what the hell is exactly happening when we are talking about price manipulation. In a particular sense, price manipulation when these bonds are being underwritten by some companies, right? So that's why there was huge opportunity. It seemed really interesting and I got into it. Quick summary of how that case went is essentially, so government agencies, they want to raise money so that they can buy people's mortgages or essentially just fund activities of home buying, right? So they issue bonds. Well, how do they issue bonds? What they do is they go to certain underwriters and ask them to underwrite these bonds. Specifically, these government agencies literally will have like a bulletin kind of a thing coming out saying that, hey, we want to issue $10 billion worth of bonds with this maturity, this coupon rate. And then all the big banks in the US will try to bid to get this underwriting contract. All the big banks in the US will try to bid saying that, okay, let us underwrite these bonds. We'll charge you this much fees. We'll charge you 0.1%, 1%, whatever it is, right, of the money you're raising. Then the agencies choose some of the investment banks that are bidding on this and decide to either go with one bank or a syndicate of different banks in general, same as in how equities are issued. And then if they choose a syndicate, the syndicate works together in actually trying to issue those bonds. So the issue that comes in terms of price manipulation in bond markets is a very specific microstructure related thing. If I ask you that, can price of, say, stock of Apple Inc. be manipulated by a few investment banks that are issuing that stock? Right now, it would be really hard to do so because everyone in the world can see what Apple is being traded at on Yahoo Finance or Google Finance or NYSE or whatever broker you want to choose, right? The price is quoted, the bid price, the ask price, both are quoted, both are very well known in the entire world because there is a central trading exchange. There is NYSE, there is NASDAQ, there is a central agency where all the equities are being traded, right? All the orders that we place go through that central agency, we get matched with a buyer and seller, and that's how trades happen. Bonds are not like that. Maybe about, I'm not exactly sure about this percentage, but I can promise that less than 1% bonds are actually listed on exchanges and they trade on exchanges. Most of the other bond trading happens on over-the-counter trading. What that means is literally, so if I want to buy a bond, I'm going to call my broker. Well, let's assume that this is 1980s and I don't have internet apparently because I'm picking up a phone. But literally, I'll call my broker and ask them, hey, I want to buy $1,000 worth of par in bonds of Apple Inc., right? So cool. That broker, suppose my broker is Barclays, that broker will be saying, okay, I'll get back to you. And then they will pick up a phone and see, hey, do any of our customers want to sell Apple Inc. bonds? No? Okay. Let's call JP Morgan or UBS and ask them, hey, do any of your customers want to sell Apple Inc. bonds? If so, we have a customer who wants to buy it, and let's match them up. Literally, there is a chain of dealers and brokers that's arranging these transactions. The weird part about this is that suppose that I'm trying to buy Apple Inc. bonds and Pia, you're trying to buy Apple Inc. bonds at a certain price, maybe 15 minutes after me. You won't be able to see what price I bought my bonds at when you are buying your bonds. The prices are not necessarily disclosed in real time to the entire public. They are disclosed with delay of about 30 minutes. So there is this 30-minute window when everyone else who is buying bonds doesn't know what the bond price is being trading at. So maybe I was able to buy the bonds at $100, and Pia, you were able to get a better deal than me, and you bought those same exact bonds for 99 bucks. It also depends on how much I'm buying, right? If I have a huge lot size, if I'm trying to invest a lot more money, maybe I'll be able to get more of a bargained discount from the investment bank, from the dealers that are dealing this thing. Maybe I'll be able to buy these bonds at a cheaper price. Maybe not. If the liquidity is really bad, maybe I'll have to pay a much higher price because I'm trying to invest so much money. So there's all these weird microstructure issues that exist in bond markets that are not necessarily there in equity markets. So that case was literally saying that suppose that there was a syndicate that wrote some bonds. They were trying to push each other's orders between themselves to pump up the price on the secondary market. And the fun part about that case was that about 30% of the bonds in whatever the bonds being alleged that were under the complaint were written by a single investment bank. And the plaintiffs were alleging that even in those, there's some price pumping going on. Well, now, I'm not a mathematician, but if I have to guess, to collude and pump up the price, I need more than one person. If there is only a single underwriter, I don't think that's mathematically possible. I can't collude with myself, right? I can't send my orders to myself. So that was the case that kind of got my attention to fixed income markets in general. Going from there, I started working on cases on structured products, some really obscure corporate bonds, some weird call options. For example, I worked on a case that this was a really funny one, actually. There was a hedge fund. So if you invest in a hedge fund, how do the managers of the hedge fund get paid? The hedge funds charge you some fees, right? They increase the value of your investments or increase the assets that you have. And on that, they'll charge you some fee. Usual structure would be 220, as in they will charge you 2% of your assets and 20% of your profits, right? We actually saw a case where a really big wealthy investor had bought an option on assets of a hedge fund. Bought a call option on assets of a hedge fund. Now think about that. It's a call option. So if the underlying assets value goes up, so will the call options value, right? Now, the hedge fund managers are working really, really, really hard to increase the value of their assets, trying to find these mispriced opportunities to increase the value of their clients' assets. And that's why they're getting paid. Except this investor who has bought a call option on that assets has nothing to do with the hedge fund, has nothing to do with the fees that all the investors are paying, and it's just benefiting based on the assets increase, the value of the assets of the hedge funds being increased. So that was a really, really interesting one. I also worked on a high-profile fantasy football case, which was kind of the crown of everything. It was really fun. But yeah, essentially my introduction to, in general, alternative investment kind of started out of nowhere, and it came to me out of nowhere. But once I saw the opportunity in there, I'm still on a daily basis intrigued by how these things work. For example, I am currently working on consulting with some real estate mutual funds. What do real estate mutual funds do? Okay, well, so generally speaking, you have REITs, real estate investment trusts. These real estate investment trusts will buy properties. They maybe own a building in New York, that's office spaces. They maybe own apartment complexes. They maybe own some land in Texas where oil production is coming from, whatever, right? They actually invest in assets. Real estate mutual funds actually invest in REITs. So they are not directly investing in the properties, but they are actually buying and selling these REITs. So when that happens, again, suppose that we were standing right now, today is, suppose that March 15, 2020, right? The COVID pandemic is just starting to pick up and it's about to hit. Suddenly we realize that government is going to freeze rents, and our investment in residential properties or even commercial properties is just really bad. As a REIT, I can't just sell a building. I can't just wake up tomorrow morning and sell a building that I own in New York easily, right? There will be price fluctuations. I'll have to find a buyer, and you know how the real estate market works if you have ever bought a house. But as a real estate mutual fund, I can easily dump the REIT that owns that residential buildings, because those REITs are traded on NYSE or NASDAQ or whatever exchange. They're just like stocks. So if that's the case, I can easily dump that. And that really plays kind of a weird, lower risk assessment towards real estate mutual funds than actually investing in REITs in general. And that's kind of something that I'm currently working on. Sorry, I'm trying to think about different things that I have actually worked on to find examples of things. One other thing I think I worked, so the structured products related stuff, I had zero ideas as to what Rmbs are or asset-backed securities were. The only knowledge that I had was reading newspapers and during the 2008 financial crisis. Unfortunately or fortunately, back then, I didn't know much about finance in general. I was studying biotechnology, so my knowledge was really, really, really limited. But when I started working on these structured product space cases, these things are really, really, really interesting. So what is a typical Rmbs? Well, a typical Rmbs is comprised of different mortgage loans for houses across the country. Suppose that there are 10,000 people who have bought houses somewhere, right? In Texas and New York and Jersey and Michigan, California, wherever. What happens is that all these mortgages maybe are written by local banks, not PNC, PNC is a national, but local credit unions or something like that. And these credit unions then sell these mortgages to bigger banks, and then bigger banks aggregate these mortgages into a structured product, as in all the interest payments, all the principal payments are being distributed across all the investors that are buying this entire giant structured product. The coolest thing about that is the differential tiers in that structured product. So 10,000 mortgages are part of this giant rectangle that I'm making with my hands. Hopefully you can see. But usually speaking, in that particular structured product, you have junk bonds, you have some investable bonds, and then some really high investment grade bonds. If you think about 10,000 different mortgages and across the US, especially around 2008 times, a lot of those mortgages were going in defaults. The risk of those things wasn't being equally distributed, right? The junk bonds in this structured product or in this Rmbs are taking a lot bigger hit whenever something goes default. They also have high returns. They also have much higher risk there. The price of these junk bonds is much, much, much lower, or subordinate, essentially, classes. So point being that the issue that comes out to be is that there is a trust that actually manages all the different tiers. There's a one single trust, and every single tier in that structured products gets some voting decisions as to how these defaults are supposed to be managed. Should we sue them? Should we capture their property? Should we have done something else to recoup our money and things like that? Now, if you're being default, suppose that out of the 10,000 loans, 1,000 loans defaulted, right? And as in 1,000 people who have bought houses aren't able to pay their mortgages just now. Well, if you're the junk bond investor, you have voting rights, right? You're essentially saying that, oh, let's get their houses, let's recoup whatever the hell money we have. Let's pay lawyers to be able to sue these people. Let's pay the banks to be able to go out there and assess their houses. Let's pay real estate agents to appraise the houses and sell those houses, all that stuff, right? Which is a lot of expense. Well, if you're at the investment grade, the high level, the senior bonds in that same structured product, you're saying that I genuinely don't care. These 1,000 loans defaulting isn't affecting me. I'm at the top of the tranche. It's not going to affect me at all. So I'm going to vote against it. So there's some weird kind of a, pretty much like a corporate board type of a disagreement, or debt to equity holders type of a disagreement that happens in there. So that's one other case that I was working on specifically. But yeah, any questions so far, or any? I know I've been talking.
There is one question, particularly.
Go for it.
Yeah. So can you please state your opinion on interest rate hikes and their effect on fixed income markets?
Sure. So that's kind of a broad question. So my opinion on interest rate hikes is interest rate hikes, well, government-controlled interest rate hikes especially, serve some purpose, right? Essentially, Fed uses these things to control the economic spending, the economic liquidity that's available in general, or the amount of funds that are available. And that has much less to do with what happens in fixed income markets or stock markets or real estate, whatever markets. It has a lot more to do with economic welfare of the country. So are interest rate hikes good or bad? Well, not necessarily. There could be really bad times to raise interest rates and really good times to raise interest rates. That's a different thing. And that's essentially, we are coming up saying that when does the Fed mess up? So that's the thing. So in general, no. How interest rate hikes might affect fixed income products. That's actually really, really interesting. So let's talk about the structured products that I was talking about earlier, right? Suppose the interest rates are hiked suddenly, and you have this entire Rmbs composed of senior level tranches, subordinate tranches, and some junk tranches maybe. And essentially, when the interest rate goes up, you're also assessing that default probability for people is also going up. Suddenly, if the interest rate, I'm going to make up this really, really bad example, maybe think that I was in Russia a month ago, and my interest rate tripled overnight, right? If that happens, my interest rate went up by 200% suddenly. I don't know if I'll be able to pay 15% interest rate on my mortgage instead of 5%, or whatever that number is, right? So the default probabilities will go up. On those structured products, obviously, the subordinate investors are a lot more sensitive to interest rate hikes and interest rate changes than the senior investors or the much more investment grade tranches. So that's one effect. In general, I mean, if you're talking about bond markets in general, higher interest rates, essentially you're saying that the yields are going higher, the risk in the economy is going higher, so on and so forth. The fun part of this actually, so I mentioned LIBOR earlier. Cornerstone actually did work on LIBOR. I'm allowed to say that because that case is far long gone from Cornerstone Research, and I did not work on that case. That was way before I showed up. But that was a really, really, really interesting and one of the biggest cases that that company had worked on because of just manipulation in LIBOR up and down affected basically the entirety of debt markets out there. So that's why.
Kind of a related note, Pratik, there's another question. Why do you think with inflation at 7.9% as of as reported yesterday, why do you think the 10-year yield is having trouble breaking through and remaining over 2%?
It's flight to safe. Oh, so this is first of all, I'm not going to actually take stances on what interest rates should be or predicting interest rates. I wrote my dissertation on predicting equities, and extensions of that are predicting interest rates, but I don't want to make any strong opinions. But if you put a gun to my head and ask me, I would say it's flight to safety. There aren't a ton of investable assets out there. People are scared what might happen to equities. People are scared what might happen to all the other possible investments that are out there. Suppose that there is a full-blown war, God forbid, but suppose that we actually have that on our hand. When people have, in uncertain economic times, people try to flee towards, they take their money out of other assets and essentially invest in US government or treasuries or government-based bonds. That essentially is a supply versus demand thing. The interest rate is being pushed down because so many people want to lend money to the US government. So obviously the interest rate will go down and they won't be able to. But that's my guess, again, not an opinion of the coming interest rates.
Thank you, Pratik. The other question I have from the audience is, how would one get their foot in into the bond market industry? How do you get a job there?
Sure. So I landed in bonds. I genuinely, I'm not kidding you. Even after my PhD in finance, I didn't know how to calculate yield on a simple bond well enough. And then suddenly I was thrown randomly into it. So I landed in there kind of randomly. But I do have friends now who work at literally bond mutual funds or pension funds or in asset management industry. Most of them are around the New York area or Texas area. But I have asked them this question because my students have asked me this question as well. Their answers are kind of vague, but also kind of interesting. One, CFA is still really, really, really highly regarded. Two, when you apply for those jobs, when you apply for, say, a bond mutual fund job or a fixed income related quantitative analysis job or things like that, you want to make sure that your quantitative skills are much, much, much more polished. For some reason, valuation jobs don't really require as much real quant skills as a yield modeling in fixed income side, right? So focus a lot on your quantitative skills, learn programming languages, learn how to run simulations, learn Python. All of that will only help you. Lastly, follow the markets. Just go to Market Watch. Just see what kind of news you are getting on fixed income markets, especially in today's world. There's a ton of talk about interest rates in general out there, right? Follow those markets. Lastly, I wish I would remember this. There is a certification out there. One of my friends who was one of my colleagues in New York, there is a certification in alternate investment assets. Just Google it, you'll land on it in the first or second link. But I don't exactly remember the name of it, but essentially that certification teaches you about, well, how do anything else other than equities might look like. It's not necessarily related to bonds, but all these other alternate investment classes that we were talking about, it's very, 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 very useful in learning that. And it's a kind of a rare knowledge too. So that might help.
The questions are coming up pretty fast here. So there's another question on what part of the bond market would be interesting to invest in right now, given the current situations of interest rate hikes, the invasion of Ukraine, supply chain issues, etc.
Not Eastern European or Russian bond markets, I guess. That's all I have to say on that. It's interesting, right? I again, this is coming towards like investment advice type of side. I'm sorry, I've worked with lawyers way too much in my life, and that's why I'm always taught to be really careful about these things. But I mean, really, like these junk side of residential mortgage bonds really intrigues me right now. The underlying assets, real estate prices are soaring. And the junk side of RMBSs, which catch the highest risk, interest rates are hiking up, especially at the same time when the original asset value is going up. That really, I think, it's just very interesting, and there could be something there. Again, just to make sure, this is not an investment advice, but I think that's an interesting area to look into.
The next question is, what reliable sources would you recommend to our students to follow for following the bond market?
Oh, that's a good question. So if you have access to Bloomberg, Bloomberg has Bloomberg Barclays Bond Index. And on any index on Bloomberg, there's a giant news section that you can get out with. Read that. Literally just read fixed income related. Like I mentioned, Market Watch earlier, I think, has a fixed income section. On Morningstar, they have typical bond mutual funds related sections. I generally, I mean, I don't typically necessarily try to follow. I'm not an asset manager, so I don't really try to follow on a daily basis as to what exactly is happening in a very niche type of a market. As in, I don't really care as much about, say, county of, I don't know what county y'all are in, but whatever county it is, how their municipal bond market is looking like and things like that. But generally speaking, I would start off with on a macro level, on a much more bigger level, just see how things are working out. Also, really, I cannot stress more. I wish I would have done it when I was getting my master's in finance. Pay really good attention in your fixed income classes. I really cannot stress more. I wish I would have done that. My life and my job would have been a lot more easier 8 years later, but seriously, it's seems like one of the most, at least to me, it seemed like one of the most boring classes, but arguably later I learned it was one of the most interesting or important classes. So.
Thank you, Pratik. And one more question is, have you seen or do you have an idea of how institutional investors are allocating more to alternative investments and less to traditional fixed income? And if this has any potential influence on bond yields?
I'm sorry, this is going to be a really bad closer. I don't. I don't necessarily have a clear idea about how that's happening. I can tell you what, so one of my really good friends, he's essentially dealing, he works at Prudential, and he is high up there in their fixed income investment side. But and I have talked to him about this and alternative investment products, even in the realm of fixed income in general. And they are skeptical from his, maybe he's just lying, maybe he just doesn't want me to know his investment strategy exactly. But from what I understood is people are really skeptical still. People are really skeptical usually for two reasons, right? One, they don't understand the product because they haven't studied it, or two, we don't know who is going to actually supply that product. or there is a serious counterparty risk, or just the risk of that product are just really, really, really high, and things like that. So no, sorry, I don't have exact answer as to how institutional investors are looking into it, except that they are skeptical to some of the alternative investment classes, especially crypto side. If you talk about these guys, well, some of them actually smaller funds, a few of my friends who work in smaller funds, they are insane. It's almost like the biggest financial investment divide ever. Some of them are really extremely interested, and they are just, yes, decentralized currency, decentralized banking. This is great. Venture funds for venture capitals are, for example, hating on crypto a lot of the times because startups are essentially saying, hey, we'll just do an initial coin offering instead of going to a VC, right? And that doesn't really work out well in the data, but still. But yeah, there's a huge divide on that side as well, that traditional investment managers or institutional managers are really skeptical, which makes also sense because there's a huge counterparty risk out there. So.
Thank you, Pratik. Those are all the questions I have for now. So if you have any closing remarks.
No, well, thank you so much for inviting me again. And yeah, if I can do anything else, let me know. You know where to find me. And I think some of our students would like to connect with you. So if you could please provide your LinkedIn or your email in the chat box, that would be really helpful. Yep, will do. Great. Thank you again, Pratik. We really appreciate it. Thank you. Thanks. All right, so we'll take a very short break here. We will be back in about just a little less than 10 minutes. We'll be back at 2 p.m. Thank you. One of these players.
Hi, this is Frank McAnulty, and our next speaker is Harrison Owen, who is a past student from Cal State Long Beach. And for those of you that have taken class with me, you know that I am the proud owner of the McAnulty crypto coin, and Harrison is the one that created that for me. He's a software engineer at a rapidly growing blockchain startup. He works on smart contracts and audits code for clients to push safe and trustworthy code. Works mainly on Ethereum or EVM compatible chains, but he does contribute to other ecosystems such as Avalanche, Terra, and Solana. And I'm very happy to have Harrison here because I'm in a constant struggle to learn what this whole blockchain thing is about. So I was very pleased that he was able to come on here and talk to us. And we have rushed Harrison a little bit because I did have him at a slightly later time, but he should be good to go now. Harrison, are you here?
Yeah, I'm here. I just need about a minute and then I'll be ready. I just have to get some water really quick.
Okay, no problem. So the reason I called this was, wanted to say this was blockchain beyond cryptocurrency is because we have all heard of Bitcoin. We've all heard of Ethereum and every other coin known to mankind, including the McAnulty. But what is this backbone and how are companies going to make money off of it? In other words, how can we make money off of investing in these companies that are going to be the backbone of this new system that, we've heard all sorts of great claims like it's going to put MasterCard and Visa out of business because you can do the transactions so much quicker, cheaper, and easier with blockchain. So that's why I'm interested in hearing what's going to happen today. And yes, our continuity here is great because we're not professionals. I'm hoping for lots of questions on this as well. This is very topical. It would be even interesting to see how this affects, because in the news recently, the government now all of a sudden is interested in blockchain because they're worried that Russia is going to use blockchain to get around all the restrictions we're putting on their commerce and moving money back and forth. So now all of a sudden the Fed's involved. And that's always been one of my things is like, wait, this is something that's almost designed for criminals to use to move money. How do we let this continue to happen? It just keeps getting bigger and bigger.
All right, can you hear me?
We can hear you. You're great.
Awesome.
There we go. Now we can see you too.
All right, is it okay if I share screens or? Cause I have.
It is. It's all set up for you.
Awesome. Can you see it or?
Yes, that's
Awesome.
great.
Should I start whenever or should I wait for 5:15? Not really sure.
No, we're all good.
All right, yeah, awesome. So, hey everybody, thanks for having me. I really appreciate it. And I'm a software engineer in blockchain. And if anybody has any questions, you can just put it in the chat or feel free to interrupt. Let me see if I can pull up the chat. Uh-oh. I don't know where it went.
Harrison, I've got the chat, so when somebody puts something in there, I'll break in when you take a breath.
Okay, yeah, sounds good.
Feed the questions to you.
All right, yeah, sounds good. So I'll just go straight into it. So I think, I mean, this is just personal opinion, but I think the topic of blockchain is extremely important for everybody to be aware of. If we want, as everybody knows, the US dollar is the reserve currency of the world. So I think that being said, and it's basically used in blockchain a lot, that if the US passes poor regulation against blockchain, then the products aren't going to cease to exist. They'll just go overseas. And because most of them are currently being built in America, I think that for America to stay overall a competitive financial service industry, that it's pretty much here to stay. And I think that at the base level, blockchain, gives power to the users rather than bank CEOs or higher up tech executives that make all the decisions for you. So if Amazon or Facebook or Twitter passes a new, I don't know, mandate or protocol or whatever, none of the users have a say in what or what not happens. But for the Web3 or the next iteration of the internet, it's a place where anybody who wants to own a piece of the network or participate in it gets to say what happens. So I'll just go on to the next slide. So basically, what is Web3? So Web 1 is before having the internet. Basically, we just had like Time Magazine articles, and then AOL came out. And then basically, you could just imagine Web 1 as like a Time Magazine article, just put on a screen for everybody to look at. And Web 2 was the boom of like blogs. And as we can see the internet now, it's just basically all the monetization for ads and kind of control over the internet is by Google, Facebook, Twitter, et cetera, controlling all the personal data. And like I said, nobody really has a say in what they can or can't do. But as I mentioned on the previous slide, Web3 is the ability to own the actual internet and participate. So the reason why that blockchain is important, and because this is the College of Business, I thought this topic would be pretty important. So everybody knows about the 2008 financial collapse with the mortgage-backed securities. And a lot of it was also due to the non-reported transactions between financial counterparties that just got constantly repackaged and re-levered over and over. And bad mortgage-backed securities just got the grade A seal of approval when they shouldn't have been. But with blockchain, that would counteract that kind of stuff, just because everything is public and on a ledger. So we can see the collateral inside, like if you have an exchange, or if, like, let's say you have a decentralized kind of exchange or decentralized place to do options and stuff, you can see all the collateral in place to see if people are actually collateralizing their assets properly. And even outside of just financial services, as I'll talk later, there are a lot of use cases, even in healthcare, for people to, it would bring down healthcare costs for oil, and even Walmart, and I forgot the company, but it was Walmart and something else are using blockchain or trying to use blockchain for the food industry. So if, for example, there's like a farm for meat, and the meat has some sort of bacteria or disease that gets a lot of people sick, instead of taking days or even weeks to find out what caused the disease, or not what caused the disease, but where the disease originated from, you could find it in 2 seconds. And as like the diagram shows, it's distributed, meaning even if one computer goes down, the entire network still has a copy of it. So there's a zero downtime. The protocol Ethereum has pretty much never gone down because there's just so many computers on at one time. Programmable smart contracts, I'll talk a little bit about later, and everything is encrypted. And there is a lot of concern, I would say, on anonymity or just anonymous participants in the network. And it's not as big of a problem as a lot of people think, like, oh, well, if someone gives me $100 million in crypto, at the end of the day, I still have to bring it to an exchange to cash it out. And these exchanges have KYC, which is know your customer. So at the end of the day, it's still easy to figure out who put the money somewhere as soon as it goes to an exchange to actually spend it in fiat currency. And it's immutable, time-stamped, and every network participant has to agree to the validity to basically have the network run properly. And just a quick overview on layer 1 protocols. So this is just like the two biggest blockchains. So Bitcoin is just a very, I guess, it's not simple, but it's a more simple blockchain because the only things you can really do on it are sending and receive assets. I mean, send and receive Bitcoin. And there's miners, and basically they bundle up transactions every 10 minutes. And they get a block reward, or every 10 minutes, they get about 6.25 Bitcoin. And then every 4 years it halves. And Ether or Ethereum has gas, which is the same thing as every other blockchain or most blockchains where to send a transaction, if I sent a transaction to Frank, I'd have to maybe pay 0.001 Ethereum or however much it is at the time. And you can just imagine Ethereum as like a phone or a computer, and you just have a bunch of applications built on top of it. As long as, I mean, among other blockchains that use smart contracts. So to put it kind of simply, this is how, I guess, our normal financial system works, is just, let's say Bob sends money to Alice through his bank or Venmo or Zelly or whatever anybody uses to send money, or I guess ACH transfer. Basically, you just have to trust that PayPal is actually going to send the money to your friend or family or a colleague. And if they don't, then I don't know. But so basically, the company just has their reputation on the line if they start not sending money and stuff. But for a decentralized transaction, if I send someone in the call, I don't know, let's say 1 Ethereum, then it's trustless. And the word trustless is used a lot in blockchain, when it basically just means there's no third party to say what I can and can't do, because regardless, the transaction will go through, and it's immutable, which means nobody can tamper with it. And this goes through with like no account balance minimums or fees or overdrafts, because there's no way to charge people for stuff like that. So this is I was just gonna go over a simple how blockchain, or like how the connecting blocks or how it's built. Basically, you could just imagine this cube right here as like a Lego brick, and the top of it is just the data. So you could just imagine the data as being like 3 parts, and the data would be it'd be like a card in a sense, like from and to. So if it came from my wallet and then I sent it to somebody else in the call, that's 2 parts of the data. And then the last part is just the amount you sent. And then you could just imagine the hash is like a fingerprint. So if you ever wanted to go on the public ledger and search the hash, you could just pull up every transaction in that block. And then I'll have another slide that kind of briefly shows how it works a little bit. And then you have the hash of the previous block. So you have the fingerprint of the last block. So on this slide, it just basically shows like when you connect them all together, you get basically the word blockchain. So for example, the first one has a hash of the previous hash, which is 00, is usually the hash for the start of a blockchain. And then it says the hash of the first block is 178F. And then you have the second block, and it has the previous hash in it. So that's how it's connected. And then the third one has the previous hash. So does the second one. So it connects all the fingerprints together. So basically, it's really hard to hack. So since the Bitcoin has been online since 2009, and it's been pretty much or mostly the same ever since, it's very hard to hack because every 10 minutes there's a new block. The code doesn't change. There's no real way for people to mess with the network, just because if they were to reorder a block, then they'd have to reorder all of the blocks before that. And it's just not possible. So to put it basically simply, so when everybody I think this slide will show it better. So you could,
Harrison, hope if I can break in for a minute, there's a question, where do gas fees go?
Well, they changed a little bit recently on Ethereum, but basically before they changed the gas fees, like let's say the block reward for Ethereum is like 2 or something. And let's say there's 300 transactions in it. And let's just put some really high number. Let's say each transaction fee is 1 Ethereum. And so you did 400 Ethereum in fees. All of those fees would go to the miner who got the block and bundled them all together. But they changed that recently to burning all the fees. So it creates a more deflationary, but basically in most networks, the fees go to the miners to create stability and to hopefully grow the peer-to-peer network that's shown on the right. So the more peer-to-peer networks, the stronger the network is. Like, for example, I don't know the number off the top of my head, but when Ethereum, I think Ethereum 2.0 is coming out soon, and I think there's 2 million nodes or something like that online at one time. Could be wrong on that, but I think I read that somewhere. And then for a server base, so let's say you're using a phone application or something, and this central computer right here goes down. Well, I mean, maybe, or Zoom or whatever, maybe your Zoom probably won't work for the next few hours or whatever until they reboot it. But for the peer-to-peer network, even if these, let's just say these are like 100,000 computers each, if one of them go out, it doesn't matter because everybody else has a copy of the ledger and the network will just keep going on regardless of if half the network went out at once. And because the whole network is communicating with each other at once, I go back to this slide. So when all these, you could imagine all these people as nodes or computers, and they're all talking to each other. And if one of them finds the new block by solving a cryptographic algorithm, it's just basically a really intense math equation. And when someone solves it every 10 minutes, a new block is found and all the transactions are, like I said, bundled into it. And all of them have to agree on the validity, and then it goes to the next block. So then it's another 10 minutes for Bitcoin, and then another, and another, another. It's always 10 minutes. So some of these pictures are pretty bad.
How do you become a node? I mean, who or what's a node?
Well, for Bitcoin, it's not profitable anymore for consumers to really do. I mean, you can participate in it. Like you can go turn on your computer and be your own node. I think you'd have to download, if I remember correctly, you'd have to download the whole ledger, which I don't know how big it is. But you'd have to download it and then you would just start mining it. But because Bitcoin is pretty energy intensive now, that you need specialized hardware. But for people that were trying to get computers in the last year, because of the price of Ethereum going up a lot, graphics cards became very expensive because people were using them to basically process transactions on the graphics cards. And because it's not, I guess, profitable to be your own node, you pool together with a bunch of other people to hopefully get the probability of hitting the next block. I'm not sure if that makes it more complicated or not.
That's great.
So basically, for smart contracts, to put it simply, they're just basically vending machines that are stored on the blockchain. So for example, if you put in $1 and you want to get a soda, you would just put $1 of Bitcoin. I mean, Bitcoin doesn't have smart contracts, but if you used Ethereum, for example, you put $1 of Ethereum and you get your soda or whatever. That's just pretty much exactly how it works. There's no third-party middleman, so there's no like, for example, if you use like a third party like eBay or something, there's no fees to use on eBay or something. You just, when the condition hits, it just sells, or the information goes through, or etc. So it's autonomous and trustless and secure. And this kind of basically sums up the two major ways that mining works. So there's two ways to basically mine it. It started off as proof of work. So on the left side, proof of work is Bitcoin, and the reason why it uses so much electricity is because let's say, I don't know the number off my top of my head, but let's say we have 100,000 computers all competing at once, and they all have to run at 100% capacity nonstop. So you can imagine this using a lot of electricity. I think it'd be easier just to say, like, imagine you had 100,000 refrigerators, or I guess maybe 100,000 microwaves running at once. So that's using a lot of electricity, rather than proof of stake on the other side. And instead of having 100,000 microwaves running at once, the network randomly chooses one microwave to run at a single time to validate the next one. So it uses, I think, when Ethereum transfers over from proof of work to proof of stake, it uses like 97 to 99% less electricity. And on the left, basically, to control the network, you'd have to have 51% of the power of the computing power of the network. Just like, for example, in a company, if you have 51% ownership of the company, you can pretty much kind of do whatever you want with it. And on the right side, because to basically, instead of having hardware and you're using electricity to validate the network, you're still using a bunch of computers and nodes, but not as much power. So basically, you pool, or you put money in like a safe deposit box, and depending on the size of or how much you put in the safe deposit box, that increases or decreases your chance of receiving a reward. And most most newer blockchain ecosystems use the right side over here, or a form of proof of stake, just because it uses a lot less electricity, and it's usually easier to, it's like the barrier to entry is a lot lower. So this is, I'm not going to explain because I don't know what this picture says, and I didn't really look at it, but the idea of it was to kind of explain other use cases. So you don't have to look at the picture at all, but I was going to explain a certain or several use cases outside of just financial services. So imagine you could use this would be like for the hospital or researchers in general. And for example, if you go to one healthcare system, and to transfer your medical records to another might take a long time, it's probably expensive internally, and just pretty much just a big waste of time. But imagine if you had all these records on like a blockchain or some sort of blockchain, and you could just interact, and it'd be secure. You could just interact and show the doctor, or you could just plug in some sort of device, and it would just upload all your entire medical history. Or maybe they could have a way to interact with it, and it would store it. And another use case of it would be for the oil industry, because 2 to 3% of all oil is lost, stolen, etc. So for oil to be tracked, you could see all the way down to where it comes out of, it's produced, every single barrel. So maybe, let's say, I don't know, barrel 1 million or something got stolen or lost. You could see exactly what point in time directly got timestamped and logged, and then it got stolen, or then you could shift your focus to there, other than maybe in today's sense where, it's just playing almost like telephone, where if something was lost, or like I said about like the healthcare food industry, where they're trying to, they're trying to be able to track down stuff to make it faster. Like if there's like an E. coli outbreak, they could see where it originated from instantly, rather than taking days or weeks. And they could, this slide was basically saying how many deaths are to foodborne diseases. So this number could be a lot lower, because if we use blockchain, for example, like I said, instead of taking days or weeks to find where it originated from, we could do it in seconds. And then we could go back to the origination or like origin and see, okay, well, the West Coast Walmart or Whole Foods bought it. So then you put out like an alert for all those people that potentially bought it, so that if they get sick, you catch it early on, so they don't get really sick, and hopefully not.
Okay, Harrison, I have a question about, we can maybe do this later. Can you explain more how hash works?
Yeah, sure. Should I do that at the end or now? I don't
You know,
really mind.
you're soon to be on a roll. Once I started talking, I thought maybe I should have held this, but why don't you keep going? We'll do it at the end.
Okay, yeah. So basically this is kind of just a continuation of what I was saying, where you can see where it was harvested, processed, who was in contact with it, etc. Because on every stage it would just be logged, and it wouldn't take probably more than a few seconds or a tenth of a second to log everything. If you have some sort of I don't know, like it just goes maybe down in like an assembly line or something, and it's just scanned and instantly uploaded to, I don't know, a food blockchain or something. So pretty sure that pretty much wraps up everything I was saying. So I can kind of, I think I have one more slide. Yeah. So another big thing that I thought was important for blockchain and blockchain ecosystems financially, outside of just having it be like a new way of money. So there are a lot of stable coins such as USDC, which is a one-to-one backed cryptocurrency, which it never goes up or down past $1. They have a bank account where if you go and withdraw, let's say you have $1,000 in USDC coins, theoretically you could just go in and cash it minus, I don't know if there's a service fee or not, but basically this is let's say that, I don't know, Bob wants to send money back home. On average, to send it back home, maybe there's a 10% fee. So he'd have to pay, well, this thing is saying $500. And so he's paying a $50 fee out of each paycheck to send it back home. But with blockchain, maybe there's a dollar fee or 50 cents, or he just deposits his check and then send it back. So he sends it back home. And on top of that, even if it costs $50, like his family back home or in another country might have to wait upwards of a week to actually receive the money. And if his family back home needs the money instantly, I mean, waiting a week isn't really going to cut it. So if they use some sort of blockchain interface, they could receive the money instantaneously and then go and cash it out and put it in their bank or something. And yeah, I'm pretty sure that wraps up everything. But if anybody has any questions, or if something needs to be explained a little bit better, yeah, I don't mind doing that.
Well, your last slide was very interesting because, there's about $20 billion a year sent back to Mexico in remittances. I mean,
I think this graph came from that World Bank spreadsheet or something.
I mean, that would save those people a tremendous amount of money.
Yeah, exactly.
And
it's also faster. So
right. There's also been talk of, using this to replace credit cards somehow, to get the bank fees out of the process. Have you heard anything about that?
I haven't heard anything about that, but you mean like, for example, Visa or American Express that has like a 1.5 to 3.5% charge on whatever fee? Like if, I don't know, you go spend $100,
right?
Like the company, or let's say like your local business only gets maybe $97 or $98 because they get charged or whatever.
Right.
So yeah, it could cut down a lot on that stuff too. But I haven't heard anything about it replacing credit cards, but I can imagine some sort of replacing it eventually. I know that Coinbase has some sort of credit card, but I don't really know how it works.
Okay. So now we have a question. Can you explain more how hash works?
Yeah, so I'm not sure the level of detail on how they wanted explained, but basically
make it for people who don't understand anything.
Basically, you could just imagine it as like, let's say you have like a Wikipedia and there's a search bar. There's nothing on the Wikipedia. It's just a search bar, and you could just imagine hashing. So the block has a hash. So I'll just go back to the slide. So the block right here has a hash, and it's just a random number, or just a randomly generated number that is attached to it. Or yeah, but basically it's attached to each block. and it's a digital fingerprint. You could just imagine it as like a fingerprint. So let's say you just copy it and put it in the Wikipedia for the block. You could just look up what transactions were in the block, and then you'll see other hashes. So the block has a hash, and you could search all the transactions in it, and then each transaction has its own hash. So let's say you have a hash and you're like, oh, well, $100 million of Bitcoin got moved. Then you could put the hash into the Wikipedia and look who exactly sent it and where the money's going. So if they sent it to Coinbase or something, or to some sort of exchange, and people think, oh, maybe, it's like money laundering or something. If it gets sent to Coinbase or Binance or something, and they have know your customer, I mean, they're going to know who it is at the end of the day anyway, but I'm not really sure if that answered your question or not, but it's just basically just a digital fingerprint.
So let me ask, so we got block one here that says, the previous hash is all zeros because this is the origination. We have one Z8F. This block two now has the code 1Z8F 6BQ1. Is that now the full hash of block two?
It's not like the full hash. So when it says hash, that's usually like it's a really long combination of numbers and letters. Okay. And basically the hash is what it's like. You could just imagine the hash being like, instead of these letters and numbers, you could just put it 1, 2, and 3. I don't know how to draw on the screen, but let's say, I don't know if you can see the cursor or not.
Yes, we can.
Okay, so like imagine this hash is just the number 1, and then this hash is just number 2, and then this hash right here is number 3. And so these are like, that's how you would click it. So if this, like I said, was 1, 2, 3, you could click on it, and it'd be that you could click on it and you could look up every transaction in the number 2 block. Now for the previous hash, it just shows the hash of this one. So if it says 1 here, the 1 would go down here for previous, and that's how you get the blockchain word, because it links together all of them. So you can see them in like a line, it just goes to infinity or whenever the blockchain, I guess, ends. I don't know if that kind of made it confusing or it kind of answered it. It's just basically like it links them together. So these are kind of independent, and like these are their own like IDs basically. And then you just connect the first ID or the previous ID to that, and then it just goes into a line forever. So the fourth block would have the hash of this one right here as the previous one to link it. And then it would have its own, then it would have its own identifier. It would have its own ID, and then so on and so on.
Okay, I've got some NFT questions, which I know you like. So how does blockchain play into the current NFT environment?
Maybe I don't understand the question per se, but
NFTs are they reliant on blockchain?
Well, I mean, yeah, NFTs are. It's just like how I said. Like you can imagine the Ethereum or any other smart contract compatible network. Let's say you have Ethereum and it's basically like a phone, and you have a bunch of applications on top of the phone. So you can imagine an NFT is an application on top of the phone. So if Ethereum, let's say the network, everybody decided, all right, well, I hate this network, and everybody just turned off their nodes, then the NFT in a sense would not exist because there's no network to support it, because the code for the NFT lives on the blockchain. So if you have a smart contract for, let's say, like, I think that eventually maybe for like real estate, the escrow side of it, you could have like a smart contract for it. So when the conditions are met, maybe they send you the deed, and then, or like you said, you get like the house basically, and then the seller or whatever, gets the money. But the origination for the code is just stored on the blockchain. So for each NFT, they're all stored on the blockchain.
Okay, so, yeah, like, when you refinance a mortgage now, somebody still comes to your house with a pile of papers about 2 inches thick. They're a notary, and you sit there for an hour and you sign things. You sign 70 things without a notary, then you always have to sign 3 or 4 with the notary. I mean, is this potentially a solution for that? Because the next part of the question is, do you see NFTs moving beyond their current role as art distribution assets towards things like legal documents, deeds, and just sort of what we're talking about?
Well, I think NFTs get a lot of flack because of they're closely related to a lot of pump and dumps, which I think is a really big concern, because I think a lot of people do lose money on NFTs because they're like, oh, well, this could be the next big thing, blah, blah, blah. And I mean, there's all obviously scams outside of NFTs, like there's MLMs, I mean, everywhere outside on Facebook or like whatever. And so I think there's a lot of applications outside of just art. Like, for example, let's say, for example, you created something or you have ownership of like a file or something. And well, let's say, you were the first person to create this file, but you can't really prove that you created it. But let's say you stored it on like a blockchain or something, then you could prove, on X date, timestamped, et cetera, that you own like the actual patent, file, or I guess whatever. You could put, I guess, maybe even like a title or the only thing I would be kind of worried about, since it's immutable, and I would be kind of worried like if you had a title or something and you forgot the password to it. So I mean, I don't know if something like that would ever be put on blockchain, just because I mean, if you lose the password, I mean, how do you like own the car or whatever, or sell the car or something?
We had that problem with, there was a story with the guy that had what, 180 billion, not billion, 180 million Bitcoin or something on a hard drive, and he forgot the password or something. I forget what the exact story was.
I can't remember. I think there was another story where there was another guy who had like a bunch of Bitcoin or something, and he's like, oh, I threw away my hard drive. And then he finally got clearance to like search through a landfill for it or something. I forgot that story, but.
Harrison, so there is a few related questions. So what can you tell us about the audit process of smart contracts, since NFT projects get exploited because of poorly written contracts? And related, how do you feel about money laundering and art theft in NFTs?
I guess maybe I would probably need better context on the art theft. I'm not sure if they mean like if people like are stealing it on blockchain and stuff, but I think there are a lot, I don't know how to like say it kind of nicely, but there are a lot of like developers that write malicious code or codes to siphon out money. And basically, as soon as the smart contractor, they, I guess, create all these NFTs, and they just, pull out the rug and just steal all the money in a sense, or even outside of NFTs, sometimes they do that with like new blockchain currencies or something, where they're like, oh, we're going to promise, and they just ramp up the marketing, and we promise all this utility, like we're going to do all this stuff. And then all of a sudden they're like, yeah, well, we're not going to do it. And then they just scam everybody. So there are a lot of stuff like that. And what my company tries to do is that like we go in and the client will come to us and we'll audit their code, and we'll do a bunch of testing on it to make sure that like there's no exploits, or there's no ways to hack into the protocol. Like there's no way to abuse it. So we go to clients, I mean, and it's up to them. Some of the clients, I don't understand, where they'll pay quite a bit of money to get their code audited. And then we'll be like, oh, well, you have some security issues here, and then they just don't fix it. So I don't understand that, but yeah, basically we just go in and try to correct as much code as possible, because at the end of the day, our company tries to make crypto as or blockchain as secure as possible for the end user, so people don't get scammed or lose their money and stuff. But we don't go out and just audit everybody's code because I mean it is kind of like a time intensive process. So we pretty much do it only when clients come and ask us to do it. Oh, I think you might be muted.
Oh, there, okay.
Sorry about that. Yeah, can you hear me now?
Yeah.
Yeah, so just moving away from the technical part for a few minutes, so there are some related questions on how or when did you first start learning about cryptos? What is your backstory of how you got into this business? What company you work for? And what do you actually do? What is your job?
Yeah, so in 2020, I graduated from CCLB with a finance degree, and I had some job lined up to do some sort of like wealth management stuff, but because of COVID, it fell through. And so I just went to community college online for a year because I didn't really want to do corporate finance. So I just did like coding classes online, and then I applied after a year at community college to the Georgia Tech online master's program for computer science. And then I got accepted, and then I was looking for internships. And then I found that my current company, which is a Certic, I mean, they were hiring for a lot of interns because there is a big need for people in blockchain because it is a new concept. And I mean, pretty much every single company is hiring like crazy. And so I mean, I started working there, I think 6 or 7 months ago. And then I ended up dropping out of Georgia Tech to do it full time. So I think I dropped like a month or two ago.
Okay, so I have a follow-up on the hash, just a comment on the hash. So the hash functions basically like a transaction ID as you move along.
Could you repeat that last part, sorry? I don't know if I cut out.
The hash functions like a transaction ID.
Yeah, you could see it. You could say it like that. It's just an ID. It's basically saying, I think it can be confusing just because it has a bunch of numbers and letters, but a lot of like they're called block explorers, and basically the only purpose of them is to, you know, like let's say the US government had a blockchain. Well, let's say the US government had an Ethereum account. It'd have like a big, large number. I mean, it'd have like a lot of zeros, X's, whatever, letters and numbers. And you could just, like I said, copy it and paste it into a search bar, and it'll just bring up every single transaction, let's say the US government has ever done. So let's say the US government operated on a blockchain. So let's say their budget of 3 trillion or whatever, and you could see every single transaction they've ever done, where every dollar is being spent, etc. So there's a lot of transparency, just because, I mean, you can see where everything's being spent. So like, for example, like how I said earlier with the 2008 financial crisis, where a lot of it was because of it was like basically because a lot of the malicious transactions weren't like reported, so nobody could really see it until the whole system was over leveraged and then went boom. But with blockchain, you can see all of that because, like I said, everything's public. So, for example, let's say Twitter gets hacked, or Facebook gets hacked, or, you know, your Gmail gets hacked, and Google releases a statement saying, "Oh, we got hacked. Sorry, guys," and then they explain what was released or what information was lost. Let's say your personal information, whatever. But then you kind of have to trust Google to tell you what was actually lost. But for blockchain, if let's say, I mean, there's been some pretty big hacks. I think there was one hack a few months ago for like $300 million. But basically, since everything is public, someone in about 5 minutes was like, oh, I can see how they hacked it. And they basically explained the whole thing in 5 minutes because everything's just completely transparent. And there's a lot of, since everything's public, even if the person stole 270 or $300 million, they can't move they can't move the funds. So it's still sitting there because at the end of the day, someone, I mean, they're like, they would get caught if they tried to launder it to an exchange. Because at the end of the day, if you want to put it into USD or any sort of, I guess, real world or fiat currency, it shows up at the end and you get caught.
You could put it into rubles. That would be good.
That's true. Yeah, you could do that.
So here's the question. Here's the question that's probably, could you explain how Bitcoin is valued?
I guess that's perspective on how, I guess, you value Bitcoin. I think that there's a lot of value just in the sense, I think it depends on, I guess, who you ask. So I think some people value it by how much electricity is being used, which, I mean, it's not great for the environment because Bitcoin does use so much electricity. But some people argue that, oh, because it uses so much electricity that we can go into like developing countries and help stabilize their grids and create infrastructure because maybe their grids can't consume that much electricity. So if, everybody turns on their power, it just goes kaput. But if they, use some sort of like renewable energy with Bitcoin mining, it could stabilize everything. But so some people price it off of how much electricity is used. Some people price it basically because for the next 100 years, the Bitcoin economic model is set. There's no way to change it. So we'll always know, how much Bitcoin is going to be coming in. There's no way to change it. And the value of like the whole network and how many nodes or how many, or like, I guess like the decentralization aspect of it. But I mean, there's like a lot of other ways. It's just, I guess it's however someone wants to, I don't know the word, I guess, cope. And
somebody thinks it's going to be worth more tomorrow.
I guess, yeah.
So here's a different question. How, as an applied mathematics major, how can I work in the blockchain?
I think that a lot, well, I'm not sure how every job works, but there are a lot, I think, I can't remember what job it was, but there are a lot of people, even at my company, that have a lot of non-traditional, I guess, like computer science background. Like I don't have a computer science background. There's a lot of people that have like physics degrees, math degrees. I don't exactly know their job title, but because I guess the space is so new that it feels like a more fair, I guess, hiring environment in a sense where it's not so much, it basically, they just want people that are interested and willing to learn rather than, they don't like it seems almost like, I guess, a joke or a meme in a sense, like they want some sort of like financial background for some jobs, or they want some like mathematics for other jobs. But like even some of the job requirements for some of them were like, oh, well, we enjoy people that scroll on Twitter or something like some of them are just, it almost seems like a meme in a sense, but a lot of them are just wanting people that are willing to learn because they just, I guess, more or less need people because it's an ever-growing industry.
Well, everybody's learning, and you just don't know where it's going to go, I think. So
yeah, that's true.
And the math major gives them a somewhat scientific mind, so that probably would help.
Yeah, I'm not sure exactly because there's way too many jobs. I guess my company and other companies that have varying titles, but there are a lot of math majors in my specific company. I just don't know the blockchain job titles. I honestly don't even know what my job title is, to be honest. I just say software engineering because it's to do with like coding and stuff, but
As long
Like
as the paychecks show up, that's okay, right?
Yeah, because I think when I signed my contract or whatever, the job title was one thing, and then when I got my first paycheck, the job title said another thing, and then I got like a congratulations email from someone, and it was another job title. So I don't even know if my company knows what my job title is.
That's a startup.
Yeah.
So I've got a couple related questions here. I'm gonna give you both of them. So the one's, how would you go about buying products with cryptocurrency, given cryptocurrency is volatile? And then the next one is, explain a bit on the crypto trade and why it is so volatile. And then the next part is, I'm not going to ask you to do, because we're not giving investment advice here. Is the next part is, in general, do you recommend investing in crypto world? But more about
I don't know if I'm going to answer that one, because I don't even know what crypto world is, but
yeah, well, buying, Bitcoin, buying Ethereum, things like that. But
yeah,
it is very volatile, and I guess people are asking, why is it so volatile? What causes that volatility?
Well, I think a lot of the volatility that you see is due to, well, like for example, there's a lot of, I guess, on the lower, like since there's outside of Ethereum and Bitcoin, I think in maybe a few others, there's not as much like liquidity as, let's say, in traditional finance, where there's trillions and trillions of dollars. So when you're moving around sometimes in these lower liquidity, I guess, coins, even if you move around just a few $1 million, it could completely just crash the price instantaneously. And I think that comparative to it, there's a lot of risk management in the sense, for example, I guess a lot of people, I guess in traditional finance are kind of like, for example, when you go into the weekend and I guess you have like an option trade or something, and on Monday, it might be zero because you have like the 2-day, on Saturday and Sunday, the market's not open. But in crypto or blockchain, it's 24/7. So there's always ways to risk manage, but I don't know if I'd answer how to buy crypto or something or invest in it, just because I don't know if that's financial advice. I don't really want to go to jail.
No, you don't want to answer that. I think Dr. Gupta has a question for you.
Yeah.
Oh, I don't think I hear anything.
Okay.
Yeah.
We'll have to ask that again.
Okay. Right. It's a multi-part question. The first one being, do you, Harrison, own a BAYC?
No, they're so expensive. I don't know the price of them anymore, but they were almost, I don't know. They were like what, 200,000 or 300,000 or something. I don't know what they are anymore, but I definitely don't own one of those.
It's a Bored Ape Yacht Club, BAYC.
Oh.
All right. So where do you think, or how do you see NFTs evolving in the next 5 to 10 years? Because currently they're mainly used for JPEGs.
Well, I don't know how it will work, I guess, with art, because I think it'll be at the point where it could become completely just, or like maybe it's even starting to become completely oversaturated. But I think that with NFTs, there's a lot of use cases, kind of how I talked in the presentation about like, oh, well, you could prove that, you own certain files or patents and stuff, and someone can't come and claim that they own something. So I think there are a lot of use cases and stuff like that outside of just like JPEGs or art and stuff, or even maybe in developing countries or third world countries where they maybe don't have like a piece of paper that shows like, oh, I have the deed to this land or something. Maybe they could have like a $3 or $5 device that just shows like, oh, I actually do own like this piece of land or something like that. Because maybe like their governments, get changed around way too much, where 1 second they own something, or in 1 second someone could just come and push them off their land or something.
Thank you. And can you talk a little bit about layer two Ethereums like IMX and Arbitrum?
I'm not too familiar with those layer twos, but I think that in the future, I mean, if blockchain doesn't, I guess, implode and it does become like a massive financial industry, I think that outside of just those layer two solutions, people in 5 years won't even know, or basic people, or like people that are getting into blockchain, or most people in general will have zero idea what network they're even transacting on. And it'll just be like some high quality, interface where, they send a transaction here or there and they have no idea what's happening, but everything does work and is like audited, for example. But yeah, I don't really know too much about those layer two, so I don't know how to answer that one.
We're about out of time.
We're running out.
Let's see, Harrison, we're about out of time. Let me see if I got one more question here that I can find. That is there a way to cancel a blockchain transaction? That actually occurred to me. You do something, so like with a credit card, if you do something and the thing goes bad, you can call a credit card company and say, hey, this is a bad deal, cancel the transaction. Is there a way to do that with blockchain?
You can cancel it. It's just like, I don't know how to describe it easily, but you can cancel it. But if let's say, I don't know, let's say the average transaction fee on some network is 5 cents, and you have to pay 5 cents to get your transaction to be pushed through by like a validator or something, because that's like the going demand at that time. And let's say you're like, oh well, 5 cents is too expensive, and you put 4 cents, and maybe it takes 20 minutes at 4 cents to go through, because the supply and demand has to go down to 4 cents to be able to send yours through. And so for that 30 minutes, and then so for that like 20 or 30 minutes that you're waiting for it to push through because you didn't want to pay the higher transaction fee at 5 cents, you could go in and cancel it. But let's say that, like I said, it's 5 cents to send a transaction, and you're like, oh, well, I want my transaction to go through instantaneously. So you pay 6 cents. And let's say, I don't know, like let's say I said block, I mean, Bitcoin is 10 minutes per block, but some of these ones have like 1 second block times, or half a second, or 10 seconds. And if you don't cancel it within like that 10 seconds and you put it at a very high, I guess, transaction fee, then you probably can't cancel it, because once it's done, you can't cancel it. I don't know if that makes sense. It is, since it's like non-immutable, there's no refunds unless, I mean, if it's gone through, you can't refund it. But there are some smart contracts that, like, for example, if you send money to Coinbase and you accidentally like screw up and you send the wrong token to the wrong address or something, I think you can just contact Coinbase and they have a way to get your tokens for you, so you don't lose them permanently, because they have like a functionality in their smart contract to be able to like pull out funds if you incorrectly do something. And so there are some smart contracts like that, but then like I said, you'd have to, it's kind of like the PayPal thing where you have to, trust the developers to actually give it back to you. But most of the time, I'm pretty sure they would.
So before you hit that send button, you better be sure.
Yeah, but a lot of things have like, oh, it's a long address, and then you can just click a button, usually copies it to like your clipboard, and then you just copy and paste it. And then you can kind of just check the first 5 numbers and the last 5 numbers. And then if those are correct, you shouldn't really ever have a problem, but it does happen where people mess up and send money to the wrong address. But you, like I said, you can't cancel it if the transaction hasn't posted yet.
Okay, well, I think everybody really appreciates this. I know I learned a little more in about another year of these. Talking to you, I'll probably understand this. But
yeah, it's kind of hard to, I guess, explain things, because I think once you jump kind of down one rabbit hole, it kind of makes everything else more confusing. So
right.
So
hard.
Harrison, before you leave, so if somebody is interested in learning about blockchain, they have experience in finance and they know some coding, what would you suggest is the best place to start? Where would they start?
I'm not sure exactly how easy it is to get like a full-time job, but a lot of companies, or I mean, especially like my company, and there are a lot of other companies that open up like a lot of internship spots. So they're not, I think it would probably be extremely hard for anybody like fresh out of college to get like a full-time offer, but they do have tons and tons and tons of internships because they need people. So, and they pay pretty competitively most of the time. So yeah, and they're all paid. But yeah, there's a lot of companies like, I don't know, Coinbase, Binance, well, my company, and then I mean there's tons that I'm sure you could find on probably like LinkedIn or I don't know.
No, it sounds like, because that's how you got your job. You were an intern for a while.
I was intern for like 4 months, and then I said, oh, well, what if I drop out of school? Would you guys give me a full-time offer? And then they said, sure. So I dropped out.
Once again, thanks for taking the time and talking to everybody. It's greatly appreciated. And
yeah. Thank you.
We will talk to you later.
Yeah, sounds good. Hopefully the McNulty coin goes well.
That's right. I just got to figure out how to make it worth something. I got 99,900,000 of those.
True.
So. Okay, thanks, Harrison.
Thank you, Harrison.
Thank you
very much. We appreciate it. Thank you.